Well, for more on what's happening on the markets and this, sense of calm, perhaps, in the banking sector, let's bring in Talley Léger, senior investment strategist with Invesco. Talley, thanks so much for making time today.
Better day for us to be talking, right?
Yeah, absolutely. Because, my goodness, what a couple of weeks we've seen here on the markets. What do you make of what's happening with SVB getting, scooped up here and the sense of calm that seems to be bringing? Do you feel a calm from the actions that have been taken?
So I would say in the near term, it's probably safe to say that where there's one or two or three cockroaches, there's probably many more. So it's probably a bit too soon to making contrarian plays in the banking space. But having said that, I think the policymakers are trying to send a very strong message that they have our backs as investors. So if you're a patient, long-term, more value-oriented investor, you should take note of the sharp improvement in the yield curve, which is actually a market proxy for bank net interest margins and could help deliver some much needed relief to future banking profitability. So if you've got a 10 to 20-year horizon, it might be time to start taking a look at some of the larger, higher quality banking organizations.
Walk us through that a little bit more, Talley, about what you could be looking for and what that means.
Well, that's the financial sector and the banks in particular. But when it comes to what this means for the broader market, I'm actually looking at five things. So we can unpack that a little bit. There's so many different ways to unpack that question. But right now, peak fear is one of my major themes. And I'm seeing a lot of lingering fear in the marketplace. But when you look historically, that actually lines up very well with major lows in the stock market. So to your earlier question, I'm taking that as kind of a reinforcement of this notion that the market, broadly speaking, is going through a bottoming process. And I think that the October lows will ultimately hold.
Okay. So peak fear is one thing that you're looking out for in terms of themes. What's another?
Well, another one, and I think it's well in the rearview mirror here, and it's very much related to Fed policy, which I think we've been touching on, would be peak inflation. Technically, headline consumer price inflation peaked in June of last year. And if this is now looking like a bona fide economic recession, I think that's the kind of growing reality here. There's more in store in terms of the disinflationary process. And in turn, that probably means peak bond yields. And, I think that's another kind of welcome sign of relief that the 10-year Treasury bond yield has come down from about 4.2% at the end of last year to something closer to 3.5% more recently.
So what more do you think the Fed needs to do from here? Because I also wondered with the stability somewhat returning to the banking sector, does that mean that the Fed might press forward, push forward and do another hike from here?
So personally, I want them to stop raising interest rates because of the rapid pace of tightening that we have seen in financial conditions, which is on par with the pace of tightening that we saw in 08-09, and that was in the grip of the Great Recession and global financial crisis at that time. So again, I want to see them stop raising rates. And I think what this pressure on the banking system does, in my humble opinion, is basically force them to take their collective feet off the monetary brake, if you will.
So in this environment, what sort of sectors would you be looking at right now, Talley?
Yeah, so we talked about probably, it being a little bit too soon to play in financials, at least tactically. So that's what not to do. What I think investors should do is rotate to the early cycle, rate sensitive consumer discretionary sector. And that sector is working. It's last time I looked, it's up on the year and has actually been helping lead this market higher, which has been actually defending a very important technical threshold around 3,800 or so. It's higher off those support levels. And I think, those 5 peaks that I mentioned, peak fear, peak inflation, peak bond yields, peak US dollar, and now it's looking increasingly like peak Fed, all together support a rotation to that key consumer discretionary sector.
Really? I mean, it is interesting because we hear people say strategists suggest consumer staples right now because those are the things that people have to buy. But the discretionary side of things, it's more optional. So if you're in this kind of environment where maybe the economy is going to be tested here, you think there's potential.
Yeah, and I think to your point, there's still a lot of confusion about the difference between the economic cycle and the market cycle. Don't be distracted by the coincident challenges to the economy right here. The market already knows about it. It told us about the current challenges in the first half of last year. That was the 25% downswing in stocks that we saw foreshadowing these key events. And I've been waiting for these major credit events because, once again, they're the types of things that kind of close the chapter on the last market cycle and herald the beginning of the next.